I've had a long experience of watching hedge funds over the years, and very few of them ever live up to the hype. There are a handful of hedge funds over time that will do well. The problem is it's impossible to know which ones are going to do well.
Are you ready for a successful retirement? We're addressing the topics facing today's retirees. Welcome to Retire with Ryan. Now here's your host, Ryan Morrissey.
Welcome back. This is episode 112. You can find this episode and the links to the episode by going to retirewithryan.com/podcast/112. As a reminder, my listener survey is live. I would greatly appreciate you filling out the listener survey. It'd take you just a few minutes. It's a 10-question survey on your experience with the podcast, things you like about it, things you don't like, things that we can improve. I want to make this the best retirement podcast that it can be. So I'd greatly appreciate if you could go to retirewithryan.com and complete that survey. So this week I'm talking about 7 investments to avoid in retirement. And in my over 20-year career of working with folks, I've seen a lot of people, unfortunately, choose bad investments, and that's really had a negative impact on their long-term success, saving towards retirement, their performance of their investments. So I want to try to help you avoid some of those same mistakes. And hopefully you're already avoiding some of these investments. So we're going to get controversial here with some of these. You might not agree, but I think you can definitely make the case that a lot of these are ones you want to avoid. So the first one is cash value life insurance. And that is life insurance as an investment. There are a lot of good reasons to have life insurance. In a couple episodes ago, I talked about term insurance, and for most people, term insurance is the best way to go. If you're trying to use life insurance as an investment, you can add a policy that has a cash value component where part of the money you're contributing every month or every year goes into an account and it earns interest. And this is a big selling point why people that push these products push them. Usually these are career agents that work for large companies who make their living off selling insurance, Northwestern Mutual, New York Life, to name a few of the larger ones, and even newer agents that are pushing index universal life. Maybe you've seen an ad on TV or you've heard an ad on the radio, seen one on Facebook. Sometimes it's called Bank on Yourself. The ads talk about the only investment that's not tied to the stock market, but you get stock market growth. Essentially, this is what these are. And they do have the ability for you to earn probably realistically 4 to 6% interest on the money that you put in the accounts. Why I think you should avoid them is because there are a lot of high fees that come with life insurance. A life insurance contract is an agreement between you and an insurance company, and if you die, the insurance company has to pay your heirs potentially a considerable amount of money. So they have to charge you for that. So those fees really take away from the benefit that these have as far as the interest that they pay. And for most people, you'd be much better off never using them as an investment. You'd be better off using an investment account outside of there, either buying bonds or stock funds, and not having the additional layers of fees that life insurance has. And also, there's costs for you to get your money. If you want to completely get your money out of it, usually there's a 15-year surrender period where if you take your money out in the first 15 years, you have to pay a large penalty. And when you go to take your money out, they always talk about how you can take it out tax-free, which you can take a tax-free loan. But again, you're paying interest on your loan, and that also really reduces the benefit. So that's why I'm not a fan of these. So definitely don't buy one in retirement. If you're thinking of cashing in your 401k and putting it into this, think very long and hard before doing that. And if you have one, it's probably a good idea to look to see if it's still worth it and maybe surrender it and do something else with the money. You can always go back to episode number 7 where I talk about what to do with old life insurance. Investment number 2 to avoid would be private real estate deals, private real estate investment trusts. And this would be a real estate deal that you're doing with a friend or a family member, or maybe a small real estate company. You can get fortunate with these deals. They might pan out, but a lot of times whatever they're advertising isn't actually true, and the deals can have problems where you overpay for, let's say, for the property if it's a flip, or there's larger maintenance costs than you anticipated, or there's large vacancies, and it's just really probably not worth the headaches. I am a fan of real estate. I would rather you see you buy your own properties, individual properties that you can control, or if you're going to purchase these, do it with a large reputable company where you've done a lot of research, you've done your due diligence, and even then things can still go wrong. Or if you want to avoid all that, you can just buy a publicly traded real estate investment trust. It's much easier to do. There's more consistency with that. And that would be my recommendation as far as how to get exposure to real estate. Investment number 3 to avoid would be hedge funds. I've had a long experience of watching hedge funds over the years, and very few of them ever live up to the hype. There are a handful of hedge funds over time that will do well. The problem is it's impossible to know which ones are going to do well. So what a hedge fund does is they're supposed to hedge the risk of the stock market. And they do this by either using options or going short on a stock, which means they bet a stock is going to go down or the overall stock market's going to go down. So they hedge the downside risk. The problem is that many times it's really hard to know when the markets are going to go up and down. And over the long term, many hedge funds fail to just be a simple index, which is the S&P 500. And Warren Buffett had a bet a number of years ago. I think he was going to pay any hedge fund owner $1 million if they could just beat the return of the S&P 500 over a 10-year period. And I don't think anyone was successful in beating it. So that just goes to show these are probably not an investment for you. If you're using, there's even mutual funds out there that try to mimic hedge funds. They're called long-short funds. And I think you're going to be really disappointed over the long term with owning these. I'd rather see you just have a traditional stock and bond portfolio and manage your risk by just keeping less in stocks. Investment number 4 to avoid, and this is kind of controversial, cryptocurrencies. Cryptocurrencies are very speculative. Bitcoin, Ethereum, these are the 2 largest cryptocurrencies out there. There's a lot of other cryptocurrencies too, and a lot of them have lost a significant amount of their value, 40, 50%, some even more. And it might prove in the long run that Bitcoin is a good investment, but there's a lot of other good investments that you can buy. You don't need to own cryptocurrencies. Another negative is they're just difficult to hold. None of the large brokerage firms, I use TD Ameritrade to hold my clients' money. TD Ameritrade doesn't allow access to cryptocurrencies. Fidelity is supposed to, but they haven't yet. Neither does Charles Schwab, Vanguard. So you have to use a cryptocurrency broker. One of the most popular ones is Coinbase. I recently read an article that Coinbase is charging a commission of around 1.5% every time you buy or sell a cryptocurrency. That is an extremely high commission. So even if you got it right with trading the cryptocurrencies, you're losing so much money on the commission that if you did, let's say, 6 trades a year, you're paying almost 10% in commissions. So it's taking away any benefit that you're getting from trading these things. I would just avoid them altogether and just, again, stick with some of the basics. Investment number 5 to avoid are variable annuities. Some annuities can be okay. I'm definitely not a fan of annuities, but I think you can do okay with a fixed annuity or an indexed annuity. Sometimes they're more conservative, but the variable annuity has very high fees. You could be paying fees of 3 to 4% a year on the amount of money that you have invested. So that's a major drag on your performance. And there are certain guarantees that the annuity provides you, but I don't really think those are worth it. There are some low-cost variable annuities. There are a few that I have access to where the fees get down lower to like 1.5%, which are a little more reasonable. They're still high. But if you're in a variable annuity, I would strongly encourage you to understand all the fees that you're paying. And if the fees are high and your performance has not been good, I would get out of them. Unfortunately, I have to help new clients get out of these products all the time because they've been in them for a number of years. Their money really hasn't grown, and it really doesn't make sense to keep paying these high fees. The guarantees and the benefits are not worth it. Investment number 6 to avoid would be the lottery, right? The lottery is probably not an investment, but many times it is called a tax that we're paying, right? You don't have to play the lottery. I know the saying goes, you can't win if you don't play. But with the lottery, if you were to take that money and just invest that in a low-cost index fund over time, you'd probably have a significant amount of money. That's going to be worth something at the end. Whereas the lottery, I mean, you might get lucky, you might hit it, but it probably isn't worth it. If you're doing it every once in a while, maybe if there's a big Powerball and you get in with some friends and coworkers, it can be fun. But if you every week you're putting money into the lottery, I would consider either just spending that money, using it on something you're going to enjoy, maybe a nice vacation, or saving that money in a retirement account or a low-cost index mutual fund. At least you'll have something to show for it at the end. And investment number 7 to avoid would be stock tips that you get from your friend, from your buddy, right? Maybe a coworker. A lot of times you're getting information from someone who is not a professional. They're not an analyst, and you're probably not doing any research yourself. You just take their word for it. You got this hot stock, you go and buy it, and then what happens majority of the time, probably 95% of the time, the stock goes down in value, and then you just kind of hold on to it. So if you're in that situation, you've bought a stock off a tip, it hasn't worked out, get rid of it. You got to be disciplined, about getting rid of investments that you buy that aren't working out, especially if you're going to be trading individual stocks. You want to get rid of your losers quickly. You don't have to ride something all the way down to zero. And just because something went down doesn't mean it will go up. It can take stocks that have gone down in value years to get back the amount of money that they've lost. So I'm definitely, again, I've said this before, I'm more of a fan of index-based investing and using index funds. I'd much rather see you just use an index fund and save the time that you would spend researching the individual investments or following the individual investments, doing something else. And at the end, you probably will do a lot better by using that strategy versus buying, individual stocks. And if you are going to buy individual stocks, my advice is to at least own 25 individual stocks, preferably in different sectors. If you're going to do that, then you have less of a chance of one or a few of those stocks having a major loss and really ruining your portfolio in retirement. So I hope it was helpful to understand 7 investments to avoid in retirement. And as a reminder, my retirement workshops are starting at the end of September. You can sign up for those by going to retirewithryan.com. Those are in person. And at some point in the near future, I'm going to be offering a class that you can take at any time on demand, and I'll let you know when that's available. Thanks for listening. Have a great week, and I'll talk to you next Wednesday. Take care.
You should consult a financial advisor familiar with your specific circumstances before you make any financial decisions. Nothing in this broadcast constitutes a solicitation for the sale or purchase of any securities. Any mention of rates of return are historical or hypothetical in nature and are not a guarantee of future returns. Ryan Morrissey, CFP, is an investment advisor representative of Morrissey Wealth Management, LLC, a registered investment advisor.